Hello everyone. Thanks for visiting the channel. My name is Colonel Profit, and you're tuning in to the Profit Program. Let's get right into it. So in this full beginners trading course, I'll be going over everything Forex, specifically what is Forex and how does it work. I'll try to give a pretty simple example as to what is cryptocurrency and how to start to get involved in that space, different trading platforms, trading types and trading styles, and how to get started trading. I break down some common terms and important terminology that's relevant to developing traders when jumping into this new space trying to be profitable. I also break down candlestick patterns and how to implement that analysis into your trading strategy. I talk about market structure, market sessions, and market phases, technical analysis, along with other sorts of analysis, and risk management. Finally, and last but not least, I'll discuss indicators and how to develop your strategy. Let's get it. Lesson 1. What is Forex? What? Like, what are you talking about, dude? Well, Forex stands for foreign exchange or foreign exchange markets, where you basically trade or buy and sell different world currencies like fiat currencies, US dollar, Australian dollar, Japanese yen, the euro, and the Russian ruble. You can also sell and trade stocks like Amazon, Apple, Netflix, Tesla, GameStop, AMC, Johnson & Johnson, whatever stocks you want to trade. You can also trade my favorite cryptocurrencies like Bitcoin, Ethereum, Shiba Inu, Solana, Cardano, Avalanche, all that good stuff. And matter of fact, go get them coins, by the way. You can also trade indices or, index like Dow Jones US 30, the NASDAQ 100, and the S&P 500. Those are profitable. So you can also trade the precious metals like gold, silver, platinum, natural oils, and a bunch of other commodities too. So with that being said, we want to buy all of these assets, any of these assets at a low price. And alternatively, we want to sell these assets at a high price in order to make a profit. You know what I mean? Because that's where the phrase buy low and sell high comes in there, because you want to buy it low and sell it at a high price. It's really simple. Simple mathematics, as in any other business, like with wholesale and retail. You know what I mean? It's all about a profit. So what is cryptocurrency? So when you look at cryptocurrencies, I like to explain cryptocurrency as basically a digital currency or like a digital asset. And unlike fiat currencies, it's decentralized. So it's not backed by any third-party banks or any central authority. You understand? And they use what they call blockchain technology. And what the blockchain basically is a chain of blocks, simply. And inside each block would include a list of transactions or a list of data, information. So each block on the blockchain is essentially like a box of receipts. So that's why they call it a distributed ledger, which is basically a list of transactions that are publicly available. So cryptocurrencies use blockchain technologies, but different cryptocurrencies are run on different blockchains. So not all blockchains are the same. So for example, you have Bitcoin, which has its own blockchain, and you also have Ethereum that has a different blockchain, which are basically known for their smart contracts, the implementation of smart contracts. So what a smart contract is essentially a coded contract on the Ethereum blockchain that basically says that if certain conditions or criteria are met, then something else should occur. So in this example, if A is more than B and A is more than C, then it should also say the result equals A. And otherwise, if B is more than A and B is more than C, then the result is B, and vice versa. So that's how smart contracts work. It's basically like a bot on the blockchain. So they have things like NFTs, which are non-fungible tokens. I ain't gonna get too much into details about those, but those are also on the Ethereum blockchain. So it's like a digital deed on the blockchain that can't be duplicated. So those are pretty interesting. Next topic, we're gonna jump into our trading pairs. When you trade Forex, you trade in pairs. So you have a base currency and a quote currency. The base currency is always set to 1 unit, and the quote currency will consist of however many units it takes to make one of the base currency. So for example, it takes $65,000 to make one Bitcoin, or around $65,000. A buy position is a long position, and a sell would be a short position. So if you want to buy, you open in a long, and you selling, you open in a short. And with each of the pairs, they trade a little bit different. So fiat currencies, cryptos, and indices all trade different. Lesson 2, trading platforms and types. So when it comes to trading can be a broad term because you have different types of trading and different platforms you can trade on. So for example, you have Robinhood, where you can trade stock options. Stock options usually have an expiration date, and the risk is limited to however much you put on the trade, and the profit is usually not capped. So with pocket options, you trade binary options, and they usually have like an expiration time, and the profit is usually capped to a percentage of however much you risk on the trade. You can also trade Coinbase and Crypto.com, centralized exchanges where you just buy it at market price and wait for the price to go up, or sell it when it's sell it at a high price, buy it at a low price, convert it to stable coins to avoid the fees. And you also have margin trading, where you trade on MetaTrader 4, Binance.us, and TradingView. You usually set a stop loss and take profit. There's no expiration time, and you have leveraged accounts. It's more risk, but it's also more rewarding. How to start trading and different trading styles. So when you start to trade, you need a trading platform. I usually use MetaTrader 4. I sometimes use TradingView and Binance.us, but my favorite one is MetaTrader 4. When you download MetaTrader 4, they give you a $100,000 demo account for you to practice your strategy with. But when it's time for you when you feel like you're ready and you want to put real money in, then you'll need to find what they call a broker. So a broker is basically like a middleman between you and the trading platform that lets you access the markets. They charge you a spread, which is basically like a down payment to open the positions, and they also offer you leverage. So if you have like $100 account and you're using 500 times leverage, you can trade up to $50,000 worth of positions. So it's pretty cool. It could be a little bit more risky, but you can also make a lot more money. Different ways to trade. You have scalpers and you have swing traders. Scalpers are usually in and out of trades. In and out of trades, they hold a trade no longer than 5 minutes, 5 to 10 minutes. And swing traders are more long-term traders that hold trade over a term of days or maybe even months. You have different types of charts as well. You have line charts, which I don't use at all because they're not too descriptive. You also have what you call bar charts. They look similar to candlestick charts, but they look a little bit more confusing because they have just the skinny lines right there. But my favorite are the candlestick charts because they just offer so much information. And it's like when you read these candlestick charts, they tell you a story. Like, you can easily see the supply and demand, the wicks, the body, and it's just a lot of information. So for example, with these two candlesticks, they show you the highs and lows for the time period. So each candlestick will be represented by a time period depending on which time frame chart you're on. You have the open of the candle and the close of the candle. You have the body of the candles and you have the wicks. So as you can see, if you look to the left, you have these candlesticks. This red candle opens where the other one closes and vice versa. So that's how that works. So the next topic I want to touch on is lot sizes. Lot sizes are basically units of currency, where they tell however many units of currency you plan on risking on a particular trade. So you have a standard lot, which is basically 100,000 units of currency, 1.0, a mini lot, 10,000 units of currency, 0.1, and a micro lot, which is the smallest lot size, 1,000 units of currency, 0.01. And you also have what they call a pip, which is basically a percentage in point, which I'll get into a little bit more in detail later, but it can differ depending on your account size and leverage. Here you have your balance, which is basically however much you have in your account. The equity, which is your balance plus or minus any profits or loss. Your margin, which is basically a down payment that you pay to the broker to open positions, which they give you back after you close the trades. That's why I say it's a down payment. You have free margin, which is the remaining amount of available margin you have left. Margin percentage, which is basically calculated by taking the equity divided by the margin that you already used times 100, and that gives you basically the health of your account. And when the health of your accounts gets too low, that's where you get what they call a margin call, which tells you to close some of those positions and that you're in danger of getting your account liquidated or blowing your account. So the farther the margin level percentage is above 100, the better. You also have the position size, the entry price, current price, and profit loss, as you see here. I want to talk about the spread. The spread is basically the difference between the buy and sell rates, or the bid and the ask price. So if you open a long position or you want to buy an asset, you have to get in at the bid price, and vice versa for a sell. The actual price is somewhere in between those, so you start off at a loss. And it's basically how the broker gets paid. Lesson 3, terminology. So in this lesson, I want to break down some common Forex trading terms, some of them that we went over previously in the course. So basically like the lot sizes, the pips and leverage, the spread, the ask and the bid prices, the margin, free margin, margin level percentage, what is a margin call? So we went over those things. But support and resistance, what is support and resistance? Support and resistance show key levels, basically like the supply and demand of a particular asset. So the support shows where the buyers have the power or where the demand lies, and the resistance would be basically the inverse, which is showing the supply or where a lot of selling pressure comes in at. Accumulation, consolidation, and distribution are basically phases in the market. I look at the distribution and accumulation phases as basically ranges or consolidation phases within themselves. Technical, fundamental, and sentimental analysis are all types of different ways to analyze the markets. So what are swing highs and swing lows? Well, a swing high describes a swing towards the high side that's higher than the previous high. And the swing low would be the opposite, a swing towards the low side, lower than the previous lows. So what are bulls and bears? Well, you have bullish and bearish engulfing, bullish and bearish candles. What bullish describes is basically buyers, and bearish describes sellers. Bull momentum is when buyers come in and push the price up, and bearish is when sellers come and push the price down. Lesson 4, candlestick patterns. So early in the course, I went over how to read candlesticks and what kind of information you can get from looking at the candlesticks. In this lesson, I want to go over the most powerful candlestick patterns I look for and how I use that analysis to implement into my trading strategy. So in the previous video, I talked about the most powerful candlestick patterns I look for, and those 3 were the dojis, the hammers, and the stars. Now these different types of candlestick patterns come in different kind of variations, but they all give off pretty much the same information. So here you have different types of dojis. You have the regular doji right here that looks like a small t. You have a long-legged doji that looks like a long lowercase t. You also have the dragonfly doji. And you have different types of dojis, and they all come like at the bottom or top of uptrends, and they usually signal reversals. Those are strong candles. You also have hammers. They look very similar to dojis, but they have a thicker body. So you have morning stars, which is usually a 3 candlestick pattern, which is a small hammer-like doji in between a bullish and a bearish candle, which usually come at the bottom of a downtrend. And the evening star would be the inverse, small hammer-like candle in between a bullish and a bearish candle at the top of an uptrend. You have bullish engulfing, which is basically a large bull candle that engulfs the previous bearish candle. And of course, a bearish engulfing would be the opposite, a large bearish candle that engulfs the previous bull candle. Lesson 5, market structure, market sessions, and market phases. So when I explain market structure, I like to look at market structure like the battle of the bulls and the bears. And I'm from Chicago, coincidentally, so that's ironic. But basically a battle between buyers and sellers. A game of supply and demand shown through the dynamic of support and resistance levels. So, when the supply is higher than the demand of a particular asset, the price drops, and, vice versa. When the demand is higher than the supply, the price increases. So you easily spot supply zones by looking at resistance, and you see the demand building on top of support. So your job as the market analyst and trader is to identify where the dominant force lies for a particular time period and find the most profitable time to enter a position that follows along with the trend. Because the trend is our friend, don't forget that. Because you can't really go wrong following the trend. Market sessions. So Forex is broken down into basically 4 major trading sessions. You have Sydney session, the Tokyo session, the London session, and the New York session. So you have the Sydney, Australia session from 5 p.m. to 2 a.m., the Tokyo, Japan session from 7 p.m. to 4 a.m., the London session from 3 a.m. to 12 p.m., and the New York session from 8 a.m. to 4 p.m. And I'm in Chicago, so I'm on Eastern Standard Time. And these are the peak trading hours. So just like market sessions, you have 4 market phases, but I like to break those market phases down into basically 2 types of market, which are trending and ranging markets. So in a trending market, the price typically trends in one direction more than the other, and in a range, price usually is like trapped in a consolidation phase. So first off, you have an accumulation phase, which is basically like a range or a consolidation phase where the price accumulates shortly before a markup or basically an uptrend. And vice versa, you also have a distribution phase where price distributes and consolidates in a range before it marks down and continues into a downtrend. So basically, you have 2 types of trending markets and 2 types of ranges or consolidation phases, which are the 2 types of consolidating phases are the accumulation and distribution periods, and the trending market consists of uptrends and downtrends. Also notice that the market tends to move in M's and W's. Like the market usually makes a big move on the second leg of the M or the W, and typically the W comes at the beginning of an uptrend and the M comes at the beginning of a downtrend. I like to look at it like the season. So the same way the market has trending and ranging phases, the seasons also have hot and cold weather, and so the cold weather or the fall and the winter seasons will be the consolidating phases or the accumulation and distribution phases, because it's not a lot of potential for growth, or in this case, potential for profits. Lesson 6, technical analysis and risk management. So with technical analysis, that just involves analyzing the history of price chart data, looking for patterns that give you an indication of what direction the price may move in next. So typically traders use indicators that measure volume and follow trend. You also have fundamental analysis, which relies on the news and uses real-world information to determine how different events affect the price. Using this type of analysis, traders basically depend on information and news articles. Last but not least, you also have sentiment analysis, which basically describes how the sentiment surrounding a particular asset can also determine the price movement. So for example, that sentiment can be FUD, which is basically fear, uncertainty, and doubt surrounding a particular asset, or FOMO, which is basically the fear of missing out. All of these types of analysis are used to predict price movements, but they just rely on different types of information. So for me, the most efficient form of analysis turns out to be technical analysis, being able to identify patterns or habits a particular market tends to make. Identifying trends and key levels help me find the strongest positions to enter. I call them positions of opportunity. So how do you analyze the market? You can use moving averages to identify the trend direction, or you can use them as dynamic levels of support and resistance. You can also use trend lines to draw up dynamic support and resistance levels, because support and resistance basically summarizes the whole market. It's just a bunch of different supply and demand zones. You can also use my favorite indicator, the MACD, which is a trend following indicator. Some traders also use what you call a Fibonacci retracement tool, which helps them identify key levels that price may retrace to. And basically what a retracement is a correction or a temporary price move away from the trend. Something like a cool off period before it continues into the trend. So that's technical analysis. What is risk management? So we all know that risk management is managing risk, basically risking less than your intended profit target. So if you was to risk 10%, you would probably be aiming for about 20 or 30%. So hypothetically, if you wanted to trade Ethereum with a $100 account and 500 times leverage, and you wanted to risk a 1 to 5 risk to reward ratio, you would be risking 1% to gain 5 and 10% to gain 50% profit hypothetically. So since we want to buy low and sell high, and we also want to follow the trend, we look for retracements towards the downside in the uptrend, and in the downtrend we look for retracements towards the upside. And a simple tip to setting a stop loss, we always like to set it just above or just beneath the swing highs and swing lows. Lesson 7, indicators and developing your strategy. So when it comes to indicators, you have indicators that measure different things. For instance, you have trend following indicators. You have indicators that measure momentum, volatility indicators, and you also have volume indicators that measure the volume of a particular asset. So these indicators can be used as confirmation to support your current analysis. And one thing I noticed about the indicators is that you don't want to use too many of them because they could possibly cloud your judgment or throw off your perspective. Some examples would be like the most commonly used moving averages, which I use to identify the trend or identify support and resistance levels. You also have one of my other favorites that I have up here, which is the MACD. That also follows trend. You have volume following indicators like the volumes indicator or the money flow index, or the alligator, which is the Bill Williams. That's actually what's up here plotted on the chart, the green, red, and blue lines, not the purple line. That would be the 200 moving average. But in this case, I just used the 200 moving average to identify the trend in this case. So if it's above the 200, I'm looking for long positions, and if it's below, I'm looking for all shorts. And I use the MACD in this case to complement the 200 moving average. I jumped more in detail into my exact strategy in the previous video where I flipped Ethereum a couple of times. Make sure you go check that out. But the indicators just help you analyze the markets better. Developing your strategy. So when it comes to developing your strategy, it's basically just like putting all of these pieces of the puzzle together. Getting to know and getting to understand how the market moves. That'll help you develop your strategy. So I like to make sure my strategy is revolved around following the price, revolved around trend direction, following the trend, supply and demand zones, and making sure I'm trading when it's higher volume. So I identify the trend. I make sure I identify key support and resistance levels, important candlestick patterns. I like to put that MACD on there so that I could make sure I'm following the trend. And I make sure I take calculated risk, because everything is about a perspective when it comes to trading. That's why I like to trade on higher time frames, because the shorter time frames give me a shorter term perspective. Another main thing is making sure you have a trading plan. So I like to keep me a journal, and when I make good trades or when I make a mistake, I make sure I write it down so that I could keep track of the mistakes I made and where I went right or wrong at. So trading is all about analyzing the market through different forms of analysis and trying to find positions of opportunity at key levels and executing proper risk management, taking calculated risks. That's it for this video. Thanks for watching. Please make sure you like this video, comment any questions or feedback, and make sure you subscribe. Thanks for watching.